morning. This is Meir Valensky with Driving Markets. Hope you're all well. Okay, so we wake up this morning and there's been explosions around Kiev, Ukraine. I've been saying for days since Russia massed its armies on the border geopolitically that Russia is going to invade Ukraine. It was so obvious, not obviously a common opinion amongst everyone, but that was my opinion. And I still think that in light of the explosions, then Putin and the Russians are going to invade Ukraine and take over the energy resources that are available there in order to give Putin more power. Where's that left markets? Well, yesterday markets completely shuddered, and overnight they've completely crashed. So you've got the Dow futures down 700 points. You've got the Nasdaq down 400 points. You've got the S&P down 120 points, 130 points. You've got the FTSE down 150 points. You've got dollar strength. You've got gold has gone through the roof. Oil has already breached $99 a barrel. All of this is based purely at the moment on geopolitical issues, which is Russia invading Ukraine. In fact, Putin warned that if anyone interferes, they'll get a very, very vicious response, a response that they would never expect us, though the world has seen. What that means, anyone's guess, who knows? But however, where's it going to continue from here? Probably extreme volatility in the markets. Historically, once a war starts, then the markets normally bounce. However, we're not too sure what the parameters of this war will be and how far it's going to go. So there will be nervousness there, the continued nervousness. All markets now are in bear territory, which is at a downward spiral with correction territory. And if this continues, you could see further significant falls on all indices across the board, whether it's in Asia, Europe, or the States. Obviously, the sought after safe havens are the 10-year Treasury, the US Treasury bonds, sovereign debt, and the classic ones, which is the dollar and gold. So the 10-year Treasury yield has dropped all the way down to 1.86%, which means that the price has shot up. The reason why the price has shot up, quite simply, is that people are taking the money out of riskier assets and over into safer assets. So you're going to have those indices that are extremely exposed to risk being hit very, very hard, and that is the Nasdaq and all the high-tech shares. They're going to be hammered further. They've already been hammered, but they're going to be hammered further, and therefore anyone who's got money in high-tech at this stage should be looking for a safe haven, because we're not too sure how long this is going to drag on for. Not really much else to say. Cryptos have also been hammered, so cryptos is a very, very risky investment, and they've also been hammered in line with the rest of the market. Probably this will continue over the next 10 to 14 days. I would suggest again that you continuously look at put options and look at some sort of security and safety for your portfolio. If you need any help or guidance on that, then I'm more than happy to be of assistance. At the moment, stay short. That's my opinion. This is Meir Valensky with Driving Markets. Have a good day.